You may know the destination, but do you know the path to take you there? This is Profits to Wealth, a show about investing and financial planning hosted by the founders of Lake Hills Wealth Management. We'll cover commonly asked questions and dive into important financial topics such as taxes, Social Security, and how to retire on your terms. It's time to talk money, planning, and freedom. Here's Jack and Jason.
Welcome to another episode of Profits to Wealth. I'm Jack Marino Jr. here with my co-host Jason Clevlen. At Lake Hills Wealth Management, our mission is to help you achieve and maintain financial freedom. And we believe that there are two things that are critically important to achieving financial freedom. The first, an efficient financial plan, and the second is an adaptive investment strategy. So, if you are retired or within 10 years of retirement, we believe having these two things puts you at a major advantage. Wouldn't you agree, Jason?
No doubt about it, Jack. That gives you a lot of confidence if you have those.
Absolutely. Well, I'm excited about today because we are going to be discussing the Federal Reserve, stimulus, and what they mean for your money. Your money, Jason.
Definitely a question we've been getting a lot of lately. Over the last couple months, I would say it's come up a number of times. Just, what does it mean? You hear about the Federal Reserve injecting trillions of dollars into the economy and, these liquidity injections. And, people want to know, what does that mean? What does it mean for my money? And that's something we wanted to talk a little bit about today.
Yeah, and I think before, we discuss the current Federal Reserve stimulus, let's just dissect for a minute or explain, what is the Federal Reserve? The Federal Reserve is basically called a lot of times a central bank. And the central bank is made up of three things. So we have the 12 regional banks that are spread across the nation. We have the Federal Reserve Board of Governors, and then we have the Federal Open Market Committee. Now, what they do is very important. So, Jason, you want to talk about what they do?
Well, basically, the Fed has a mandate, and the Fed is short for Federal Reserve. Their mandate, they have a dual mandate, and the dual mandate is for full employment and stable asset prices or stable prices. Mm-hmm. And, it's important, I think, to point out that full employment does not mean 100% employment, but they're trying to help manage as best they can, the conditions of the economy that allow, for a high level of employment. And, we want to avoid high levels of inflation as well.
Right.
And the way they do that is through their monetary policy, through their, with their open market committee trying to manage the money supply to affect interest rates and lending conditions.
Yeah, and they're also going to set the reserve requirements for the commercial banks as well. So that's another way to promote liquidity in the system or easy financial conditions by setting lowering or raising the reserve requirements for commercial banks, and they also control the rate at what's called the discount window. So if I can't borrow money from my neighbor bank, if I'm a bank and I want to borrow money, I need to meet my requirement for the reserve requirement. I can either go to a bank, another commercial bank, or I can go to the discount window, and that rate is called the discount rate. So the Federal Reserve does directly control that particular interest rate. So what does the Federal Open Market Committee do?
Well, the Federal Open Market Committee, they decide on what their policy is going to be for targeting interest rates. If they're seeing growth slow down, they will discuss lowering interest rates, and essentially they create money and they take that money that they create at the Fed and they purchase assets, primarily treasury securities or treasury bonds. But they've recently expanded that where they can buy other types of assets as well. mortgage-backed securities and municipal bonds. And,
corporate bonds. That's
Yeah.
a newer thing. Yeah. And then they also, like you said, so when we talk about controlling interest rates, they don't directly control interest rates. They set their target rate, which in effect is the rate, a lot of times the benchmark rate that the commercial banks lend to one another.
Correct.
Right. So that's another way of either tightening conditions or loosening them.
Right. They're focused on very short-term rates, basically the overnight rate that banks use to borrow. They do not directly control long-term interest rates, mortgages and mortgage rates and any of that. That's all controlled by the market. But indirectly, the decisions that the Fed makes has some impact on those longer-term interest rates as well.
Yeah, they're not saying, hey, we want 10-year Treasury to be at 0.65 today. They can do more buying in that 10-year bond range, right? But they're not going to set the rate,
right?
Just to make sure everyone understands that.
Yep. When they're trying to lower interest rates, they are actively in the secondary market buying bonds, and the more demand that you have for various bonds, the lower the interest rates are going to go. And the less demand that there is for bonds, the higher the interest rate's going to go. If you're trying to sell a bond and, nobody wants to buy it from you and it's, currently paying a rate of 5%, well, if you start discounting that price, whatever that coupon that the bond was paying suddenly becomes a little bit higher rate of return if you're now paying 90% of face value versus 100% of face value. That coupon becomes a higher rate. So the rate can fluctuate based on the bond prices. And so as they, through the Federal Open Market Committee, actively go into the secondary market and start buying bonds, that can push interest rates lower.
Yeah, so the point being here is the Federal Reserve System is pivotal in the ebb and flow of financial conditions, right? So they can, again, make financial conditions more loose or tight based on the mandates that they have and the tools that they have in their toolbox. And the big one that, the difference that we saw this time versus 2008 is the buying of municipal bonds and corporate bonds, because they did not in prior recessions have the ability to buy those. They only had, as you mentioned, they only had the ability to buy treasuries. And that is what puts what we call the Fed put, or don't fight the Fed, because they are increasing the money supply and lowering interest rates to promote liquidity in the system. So let's talk about what's happened since, during this COVID-19 pandemic. So the Federal Reserve first started out by lowering interest rates. They did that twice, back to back. They went from 0.5, a whopping 0.5% on their target rate, to 0 again, just like they did in 2008, except for in 2008, obviously was a different causation of the recession. But we were, I don't know, off the top of my head, around 3.5%, 4% down to 0. And this time, obviously, we were 0.5 to 0. So they lowered the target rate, which again is going to promote commercial bank to commercial bank lending. Then they also changed their discount window. So the discount window rate went from 3% a year ago to now just 0.25, which again, so now if I'm a commercial bank and I want to go to the Fed to borrow money, I can do that at 0.25% too. So really inexpensive way to borrow money. The biggest thing is the bond buying. You want to go through, what they did there?
Yeah, well, basically there was a huge, what we call liquidity crunch. You had a lot of investors as well as companies, people wanting to raise cash. And when everyone's trying to sell the same assets and you don't have enough buyers to come in and provide that liquidity. A lot of times the Fed will step in and act as the lender of last resort and basically create cash through their quantitative easing policies and step in and buy those bonds, which there's not enough buyers. And basically they put those bonds on the Fed's balance sheet. They put it on their balance sheet and thereby injecting cash into the economy. And so far, they've already injected over $3 trillion into the U.S. economy as a response to this downturn that's been created by COVID-19. And that's a lot of liquidity. We can see that showing up in the M2 money supply, which that's a measure that economists use to take a look at how much money is out there. It includes cash, checking deposits, savings deposits, money markets, even some mutual funds and CDs. And so you can see there's been a direct impact to the M2 money supply with all of the liquidity that the Federal Reserve has injected so far.
Right. And so to put that in perspective, I know the economy wasn't exactly the same size in 2008, but that $3 trillion only took a matter of weeks versus 4 years last time. That's a lot of liquidity in a very short period of time. And so, as you mentioned, that $3 trillion of, let's say, money that goes, so they're buying bonds, and then that's an exchange of security with money, right? And that money goes into the system, shows up in the M2 money supply. So what happens, if you have a bunch of new money in the system, historically what happens is people use that money. Corporations borrow, they invest in human capital, plant and equipment, and it eventually trickles down to the employees, the consumer. They have more money in their pocket, and the idea is that they'll consume, and now we increase the output or the GDP for the United States.
Right, that's the goal. And there's always, whenever you see these big quantitative easing programs where the Fed is injecting money, you always have this concern that we're going to see some kind of major inflation down the road as a result of it. When you increase the amount of money, that exists in the system, that's inherently an inflationary pressure. And we heard a lot about the potential for that happening post 2008 and 2009, but it never really showed up. We never really saw massive amounts of consumer price index inflation post 2008 and 2009. And so, will we see it this time? Nobody knows for certain. I guess we don't know how much additional quantitative easing the Fed may do moving forward. That remains to be seen. But what we do know is we can look back at the last time, which was post-financial crisis, at what were the results of the Fed's actions. And I think the biggest result that we saw was the stock market did inflate.
Right.
In the years following, the 2008, 2009 downturn.
Right. And one thing that's different this time, because this is a different situation, is actually the Treasury. Congress approved, of course, the CARES Act, and the Treasury actually increased their debt by $2.5 trillion, which went to the direct stimulus to, the citizens, right? And then also part of that was the PPP program that went to businesses. So consumers and business this time got some quote unquote direct payments as well. So you add all that up, let's just say, that's roughly $6 trillion of stimulus there. And I don't know that they're done. And to your point, I think last time everyone thought inflation was going to spike, which, there may have been little burst of inflation here and there, but I don't even know if I would use the word burst. It was really, we didn't have any inflation. Inflation has been very muted. And one thing, I guess, reason for that is that the savings rate has actually gone up. If the money just sits in the bank and doesn't get used, and M2 money supply, the velocity of M2 money supply actually doesn't increase, then maybe inflation, we're not economists, but that's probably part of the reason why we didn't get inflation. So we don't know if we'll get inflation this time or not. But what does all this mean, for your money? I know we've looked at returns. Obviously, the returns, as you mentioned, for the stock market were very good, especially for growth stocks. But for all stocks, for bonds, mainly, all asset prices increased. So the point of all of this is that, sure, we may have some volatility. There's some uncertainty in the short term. I know, if you look a little longer term, this is probably a great environment to invest in stocks and bonds. We don't, here at Lake Hills Wealth Management, we have a different strategy. We just don't look at history and just say, hey, last time this happened, all asset classes went up, so let's just, pile in. We use indicators to control risk in everybody's portfolio. So we are indicator based, and right now everything is pointing to growth or stocks right now, not protection or bonds. But I will say, I think it's a perfect time if you're nearing retirement or in retirement and you've done very well recently with the huge run up in the market that we've had of over 40%, then I would suggest that you give us a call and do a complimentary portfolio review and financial plan. Again, 2 keys to financial freedom. The success of that is going to be an efficient financial plan and an adaptive investment strategy. So give us a call, 512-580-4740, or email Jason or myself. Jason is Jason at lakehillswm.com, and I'm Jack at lakehillswm.com. So Jason, it's an interesting time, but as history has shown, like we've said, asset prices are going up. It has never been a better time to review your portfolio and invest in the markets.
Definitely. We'll keep watching. We'll keep looking for opportunities. And I think, the biggest takeaway here is last time we saw this playbook, the stock market did well. Hopefully that's the same playbook we see this time around, but we'll continue to monitor and look for opportunities. And if any of our indicators start suggesting caution, we're always ready to make changes as needed.
Absolutely. Well, see you next time, Jason.
See you next week, Jack.
That's all for this episode of Profits to Wealth. But we have more resources available to you on our website. Head over to lakehillswm.com to request a free financial review or subscribe to receive weekly insights from Lake Hills Wealth Management. Until next time, we look forward to uncovering your path to financial freedom right here on Profits to Wealth. Investment advisory services offered through Lake Hills Wealth Management, a registered investment advisor. The information and views discussed on this show are not intended to be taken as individual advice. Additionally, past investment performance does not guarantee future results. Everyone's situation and goals are different. Please consult a professional about your specific situation before taking any action.